Welcome back, everybody, to another episode of In the Money, where we help to break down trading strategies and share actionable ideas with you, the trader at home. My name is Chase Codmore, a brokerage content editor here at Fidelity Investments. Joining me today, as always, is Mr. Tony Zhang, the chief strategist and co-founder at OptionsPlay. Tony spent the better part of 16 years helping to educate clients on a variety of topics, whether it's trading, risk management, and of course, options. Tony, it's good to have you back here on the program today. I think, like everybody else, we're always looking forward to seeing what's on your mind. What are some of the option trades that maybe pique your interest? So, what I'm hoping to do today from an agenda perspective is to look at the macroeconomic situation, see kind of what's going on, what stands out to you, and then hop into a couple of option trades. So, it's good to see you here back on the program this week.
Yeah, thank you so much, Chase, for having me back. I think when we look at the overall markets, it's important to first look at where we stand. And we kicked off this week on a fairly positive tone with the S&P 500 hovering just shy of that $7,000 level here. After what has been multiple all-time highs we've seen over the last week, trying to push above that $7,000 level. Now, so far, even though we have this positive tone pushing on this major psychological level, there's still some fragility, I would say, to this overall market. And you see it in the fact that gold and silver continues to trade at all-time highs. This is showing us that, there's still a rising demand for safe haven assets. Typically when you see equity markets ripping higher here, gold and silver is really lagging behind here. But the fact that safe havens are still in strong demand here, makes this rally feel a little less secure. And the lack of momentum above, as we push towards the $7,000 level so far, has been somewhat concerning as to whether or not the markets have the momentum to continue moving higher here. We did see the inflation print earlier this week confirm that inflation continues to cool. And that supports the Fed's current patient stance of having no urgency to continue tightening interest rates. And that's going to provide a bit of a headwind here for equities, especially if you see the 10-year yield remains at that 4.2% level here. This is going to be a headwind for equities, especially if you look at the rest of the market. Now, what's interesting is the fact that earnings season just kicked off here. We had early banks report so far, and the bank earnings so far have been somewhat mixed. You have some, profit and revenue beats, but also at the same time, we've had a few misses by some of the major banks. And at the moment, the Q4 expectations for EPS growth is about 8.8% year over year, which is pretty strong. However, I do think some of that has been priced in the rally that we saw here at the end of last year. And we're really looking to see whether or not we do get that confirmation of continued earnings growth that's required, in my opinion, to support the current rally that we've been in. So as we focus, going forward, this is really going to start shifting towards the guidance that we get for companies as earnings season season starts to ramp up again, because so far the guidance here for 2026 has actually been fairly strong, even from the companies that have potentially, we had a couple of early reports that have missed on earnings. They still report fairly strong expectations for 2026. And that's what's been holding up the markets despite some of the big misses we have seen. Now, market breadth continues to improve, and that is a really good sign here. If you look at the equal weight S&P 500 ETF RSP, you see that the RSP equal weight S&P 500 index continues to outperform the market cap weighted S&P by roughly 4% over the last 2 months. So this is confirming that the broadening that we've seen over the last 2 months have continued, and this is a really good sign, a constructive for the S&P 500 at these new all-time highs. This leads us to believe that there are legs for this market to continue moving higher here, especially if you look at the VIX, under 16% here. Investors are not particularly concerned about any of the macroeconomic events that are coming up here. We have seen some short-term spikes here in VIX, but we've seen those kind of turn back lower here as well. So it seems like market participants aren't particularly worried here, and we might just continue to see this grind higher here. But earnings season is likely going to be what is going to be driving the markets going forward. Either we get more of a consolidation here just shy of the $7,000 level, or we break out higher. And I think we're going to see some of that here over the next couple of weeks as earnings season develops.
Yeah, that's a good breakdown, Tony. And it's interesting that you mentioned the gold component or maybe precious metals more generically speaking. I was reading an article the other day, and trust me, I don't consider myself a scientist or a chemist, but they were talking, Tony, about how so much gold and these different precious metals that we sort of know as stores of values are actually used for like physical purposes in these data centers. For example, they were talking about how these AI infrastructure data centers, these kind of mega computers that we're building these days, apparently have a lot of gold components and gold plating. So it's kind of interesting from an investor's perspective to think not only is there the financial aspect and the trading market aspect, but we have to remember that sometimes there's like a real economic or real productivity aspect to some of these assets that we trade or invest in. Also, you mentioned some of the financials, whether it's JP Morgan Chase, Citibank, Bank of America. You're definitely on the money when it comes to the fact that a lot of these financial institutions reported earnings. I think for the option traders who are trying to trade earnings, always provides some kind of opportunity for them to take a look and see what's happening in the marketplace, which keeps it interesting. With that being stated here, we talked about the macro, we talked about some of the precious metals. Tony, let's pivot into the first trade idea of this week. What's on your mind?
Yeah, in this type of market environment where interest rates have remained stubbornly high, valuations overall in terms of equities remains on the higher end. My preference is to focus on higher quality companies that are generating substantial amounts of cash flow for their businesses to protect their margins. And one particular name that I think recently is worth taking a look at here is Airbnb, because Airbnb since the IPO has really been priced as this high growth travel stock, tends to be on the more volatile side. But over the last couple of years, the stock has really quietly transformed into a cash generating machine. We're starting to see record profitability and accelerating free cash flow. And they've continued to execute well on monetizing new sources of revenue, such as their services business. So if you look at a chart here for Airbnb, the stock has been largely range bound between 110 and 140 for the last year or so. But it recently started to break out above a minor resistance level in the 130 range, and now trading up to that 140 level here. Even though it's pulled back a little bit from that 140 breakout level, this is starting to show some signs of higher highs and higher lows in the start of what could be a bigger, broader bullish trend here. If you look at the breakout here, this supports a potential move here up into the 150 to 160 range above the trading range that it's stuck in over the last year or so. If you look at the fundamentals, we just saw a record EBITDA around $2 billion in Q3, generated a record free cash flow of $1.3 billion. And more importantly, EBITDA margins are now over 35%. So this is a stock that is generating far more profits than anything in its peer class. Yet, it trades at a valuation that's, meaningfully discounted around 20 times forward earnings. So, you add on top of the $1 billion in share buybacks they just did in Q3. I'm expecting that that's likely going to be a trend that will continue into the next few quarters, especially as they continue to generate record free cash flow. So if you look at kind of the business, they've essentially established a floor here for profitability, which is best in class in terms of its peers. They've started to see some substantial growth from the international market because the US market has slowed down substantially in terms of growth, but we're starting to see strong growth out of the international markets, such as in India and Japan. And then more importantly, their services business. They've started to add this asset-light revenue stream similar to your traditional hotel chain like Hilton, where it's based on services and there's no asset, a capital expenditure in terms of investing in those particular businesses. And that's going to generate operating leverage. So all of these things are they're executing well on and showing record profitability, which is why I think this is a really attractive time to be taking a look at Airbnb. Now, we do have to factor into the regulatory pressures that Airbnb continues to face in the major cities, and that's really one of the major downside risks that I do see here with this particular stock. But that's why I think the best way to play this is to utilize options. And I'm specifically going out to the February 27th weekly expiration, and I'm looking at selling a 133 123 put spread. So what I'm doing here is I'm selling the 133 puts, and then I'm buying the 123 puts against that, collecting about $3.55 as a credit on this $10 wide credit spread. And that has a total risk of around $645 per contract to potentially make $355 per contract if Airbnb stays above 133, risking that 645 if the stock is below 123, which is well back into the trading range from last year. If that were to happen, that's the downside risk that I have here. But I have limited risk in this particular case, no matter how far Airbnb, if it were to drop going forward.
Yeah, so just to kind of summarize for myself, Tony, that's an awesome breakdown. So it's sort of that the company is reimagined maybe their vision or their ability to execute, and we're seeing a change in the trend, right? Maybe before it was more neutral, now it's a little bit more bullish, and because of that, we're trying to position ourselves to a bullish neutral type of position, which this spread would certainly put us into. Okay, that makes sense. Now, I want to pivot for just a moment. I was looking through, we've updated the registration process for this program, as our viewers know, here on Philly.com. And so when someone registers, they can actually now leave a question. So I was going through hundreds of questions that we get every episode from now on. And we got a really good one from Steven. I wanted to ask you about this trade, which is how do I choose my strike price and expiration selection from a process perspective? So, Tony, I know you went through kind of macro, went through from a fundamental perspective, even some of the technicals as well. But, when you look at this trade, is there a rule of thumb or is there something you're looking at to help you pick strike and expiration selection?
Yeah, absolutely. So if you look at the credit spread that we just looked at here for Airbnb, my preference for selling credit spreads is to prioritize having the strongest risk to reward as possible. Because whenever you're selling an option, you generally are risking more than what you can potentially make. So I choose my strike prices, generally speaking, more aggressively to try to limit the downside on a credit spread type structure like this. So I like to sell a put that's very close to the current price of the stock. So the stock's around 133. I'm looking at selling the 133 puts, essentially an at the money put. And what that's going to do is maximize the credit or income that I'm receiving from the primary driver of this particular credit spread, which is the short put. Now, the reason we're buying a lower put against it is because if you were to just outright sell a put option, you are going to require, number one, a substantial amount of margin. It's going to require a substantial amount of risk if the stock were to drop. So the reason I'm buying that 123 put against it is to offset the risk, because by buying a lower put option, you significantly reduce the amount of margin required to hold on to this short put. Many times you're reducing it by 90 to 95%. And this way allows you to take a similar risk profile of just selling a naked put, but doing so with far less cash and far less margin. So choosing that strike price of that 123 put option, I usually like to take a probability based approach. And what I use for that is the Greek delta. Delta approximates what is the probability of the stock being below that strike price at the February 27th expiration. So I'm choosing roughly a 25 delta, meaning there's a 25% chance the stock will be below 123, and that will usually cost about a little under half of the cost of the premium that I collect from selling that at the money put option. And that's going to, like I said, reduce the margin requirements of selling a put option by about 95%. So I'm reducing my risk by about 95% by using a put credit spread versus just an outright put. So that's generally how I select my strike prices. In terms of expiration dates, whenever I'm selling options, I generally like to go start off my research at around 45 days to expiration. That's why I'm using the February 27th weekly options. That's about 45 days out. And this gives me about 3 to 4 weeks that I can hold on to this trade for, where I'm trying to capture the acceleration in time decay. I want to use a relatively short dated option because time decay is working in my favor. And that's why I'm using about a 45-day option to do so.
Yeah, and so what stands out to me, Tony, that's a great breakdown, is that when you say the word aggressive, we mean aggressive in terms of risk management, right? Protecting yourself, limiting the capital exposure that maybe you would need for the position, and also using data, right? We make it available to all of our traders now here at Fidelity and elsewhere. Let's use it to our advantage, whether it's the option Greeks or others. So I love that. It makes perfect sense to me. All right, I want to pivot for a moment here. We talked about the first trade, which in this case was a bullish setup. Let's talk about your second trade for the day, which happens to be a bearish setup in this case.
Yeah, I want to take a look at some bearish setups here as well, because the market has really struggled at that $7,000 level here. We continue to hear concerns from investors with regards to just the stretched valuations that some of the tech companies are trading at, specifically AI related software companies seemingly are the ones that investors are most concerned about. And one particular name that really stands out here is Cloudflare. Now, if you look at the business here, Cloudflare is really executing on all cylinders. There's really, they just recently had what seemed like a flawless earnings announcement the last quarter, Q3 of 2025. But what you're seeing is that while the fundamentals are improving, after that earnings announcement, the stock has actually, the only thing the stock has done since that record earnings announcement is that the stock has moved lower. So what this is showing us, the valuation that the stock is trading at is no longer supported in this world where interest rates have remained stubbornly high. You look at the stock here, if you look at the chart, the stock traded all the way up to that traded up to about that 250 level here, which is where the last earnings announcement was announced. Yet since then, the stock has continued to decline, lower lows and lower highs, and it recently got rejected at that 210 level here, and we're just knocking on the 180 support level. If the stock breaks below 180, that would complete a roughly 7 to 8 month topping formation, what you would typically classify as a head and shoulders pattern. And if the stock breaks down below that head and shoulders pattern and completes that head and shoulders topping pattern, that would target a move all the way down to 130 to the downside. So we're talking about substantial moves here to the downside. And especially if you look at the fact that the stock over the last 3 months or so has continued to underperform the S&P 500. That's really where I think the risk lies, is the fact that the stock, after setting record earnings, the stock has only moved lower and underperformed the S&P 500, broke below some major support levels, and now knocking on the biggest support level that could bring it all the way down to 130. That's the downside risk that I see here with Cloudflare. Now, my view here is not just rooted in looking at the charts or what I'm seeing here from the business, but if you look at the fundamentals, there's really very few stocks like Cloudflare trading in the range of valuation that's traded at. Tesla is probably the only exception. Cloudflare is trading at 160 times next year's earnings. That's just a valuation that is incredibly difficult to wrap your head around, regardless of how well you think the stock is performing, because they're trading at nearly 40 times revenue. It's not just they're trading at a high earnings multiple, they're also trading at an incredibly high revenues multiple. And you add on top of the fact that they're not particularly profitable because they have to spend very aggressively on marketing in order to gain market share. And we're starting to see the cloud companies, specifically Microsoft and Azure, start to offer some of the same services that Cloudflare offers is for free on their cloud services, in order to squeeze out, stocks like Cloudflare. So this is really where we're starting to see that the AI race that, these companies are all in, especially on the software side of things are heating up, and companies like Cloudflare are potentially likely going to get squeezed, in my opinion, by bigger players in Microsoft and Amazon that already have those customers. So if they can offer these types of services for free as part of their cloud services, that's really where stocks like Cloudflare have some significant downside risk, especially at the valuations that they're trading at right now, which is essentially priced to perfection as if they are winning the AI race. And I think that is far from a far gone conclusion. So this is really where, if I'm looking at opportunities here, this is where I prefer buying an option because of the size of the potential move here to the downside. I prefer to be a buyer of puts. So I'm going out to the February expiration. I'm looking at buying the 190 put and then selling the 155 puts against that. If you were to buy the outright 190 puts, that would cost you approximately $15.50, which is a pretty substantial amount relative to the stock price. You're talking about nearly 8% of the stock price it would cost you to buy roughly a 1 month put option. However, because it costs so much, I prefer to sell a 155 put against it. That's going to collect about $3.25, offsetting about 20% of the cost of the put option. So my net debit on this is going to be about $12.25, which brings down the cost of this trade to maybe around 6% of the stock price. And that's going to significantly reduce the total risk to around $1,200 per contract, while increasing my profit potential to around $2,200 per contract if the stock is below 155 by that February expiration. And remember, my downside target here is 130. So I'm leaving myself plenty of room here to the downside so that if it does reach that 155 short strike on my debit spread, I can roll this into a new debit spread and potentially seek further downside if it does start to break below that 180 support. So this trade essentially gets me into the potential breakdown, and if it does break down, I have the opportunity to potentially roll that into a new trade and try to hit a home run if it does get all the way down to 130.
What stands out to me, Tony, on these two different trades, if we compare and contrast them, besides the fact that one's bull, one's bear, is the risk to reward ratio, right? You had mentioned that a little bit earlier in today's episode. And I think this highlights it pretty clearly in this case, where if you have a credit spread, as we talked about earlier, it's not uncommon to see actually more risk than reward in that ratio because you're taking, a potentially higher probability trade and you're also receiving a credit up front versus putting your funds at risk. Where in this case, for the second trade, it's more of like a 2-to-1 reward to risk ratio because you're paying money up front and you're leaving a little bit more room on the spread and you're trying to as you say, hit that home run or at least try to be a little bit more profitable. So I always encourage traders when you're trying to think to yourself, like what's a reasonable setup for whatever my outlook might be on a given stock, ETF? Think about like that risk to reward or reward to risk ratio, however you want to put it, right? Think about what makes sense for you in your strategy. And I think in this case, in this episode, we've been able to highlight kind of both ends of that spectrum. Now, when we think about reviewing our trades, Tony, I want to do a quick look back here at a previous trade for AKAM. Talk to me about kind of the performance of it. Are we happy with it? And more importantly, moving forward, what are we looking to do with this trade, if anything?
Yeah, so back in December, I laid out a bullish thesis here for Akamai, a content delivery network that has rebranded themselves recently for edge computing for AI companies. You know, at the time the stock was trading around $86. We looked at buying the January 85 by 95 call spread. The stock has moved nicely higher here. It's now finally broken out above that $90 level. It didn't quite reach that $95 level here. We bought the January 85.95 call vertical, so that's expiring tomorrow. We bought it originally for $3.40 earlier today. It was trading around $6.35. So if you were to close out this trade just by itself, you're looking at a gain around $300. So nearly just shy of a 100% gain on this debit spread. However, because we've broken out here above that $90 level, you know, that extends my upside target here to around the 100, 105 range. So instead of just simply closing out this trade and walking away with a nice profit, I think it makes sense to now roll the profits into a new trade. So now I'm looking out to the March expiration, buying myself another 2 months worth of time and buying a 90 by 105 call spread. Earlier today, you can pay about $5.20 for that debit spread. And what that means is I'm taking the profits from my first trade, buying a new trade, and that's going to lock in some gains. That's going to extend my time by about 2 months and gives me maintain my upside exposure while locking in my gains. And by doing so, it significantly skews my risk to reward further in my favor. So if you look at taking the profits from the first trade and applying it to the second trade, now my total risk on the second trade is only going to be $520 and $225 versus my maximum reward now for the new trade is $1,275. So I'm looking at a nearly 5-to-1 risk to reward ratio on this particular trade because I was able to roll the profits from my first trade into the second trade. So if this bullish trend continues and my bullish thesis works out, then I have a really strong risk reward ratio. And when I was referring to before of potentially hitting home runs with Cloudflare, this is a good example where you take the winnings from an initial trade, roll it into the second trade, and now you have the opportunity to potentially hit a real home run if Akamai continues the bullish trend that it recently just started.
And what I'm hearing, Tony, is a consistent theme of, aggressively managing risk, maybe not chasing profits. It's being wise with the dollars that we're spending or thinking about the risk to reward ratio with the credits that we're receiving. And I think these are all key tenets that make sense, especially for our beginner traders. And, one of my takeaways from what you just said there is that we're trying to show up every single day as traders to get a little bit of profit here and there, right? That's kind of what that role really is. It's take a little bit off the table, kind of keep chugging along. And when I used to coach clients on this in the trading strategy desk, I would tell them sometimes you can think about trading like a job, right? You're showing up to your 9 to 5 and every day you go to work, you don't expect to win a lottery, although you certainly could hope, right? But you're trying to earn your income a little bit every single day and stack it up, and that's how you accumulate your wealth. And so I think sometimes we look at these trade opportunities that can be a helpful sort of voice in the back of our head to think, oh, I'm just showing up for work, just trying to get a little bit of profit over time to build up our capital. And I think if we're trying to build up our capital or our portfolios, that's a goal worth having. I think we all probably share that here. But Tony, thanks for being here with us today. Definitely appreciate your insights. Thank you everyone for viewing another episode of Into Money. Just a few reminders before we wrap up today's session is don't forget we do have a follow-up session that's hosted by the Trading Strategy Desk. That's going to be tomorrow, Friday at 1:30 p.m. Eastern Standard Time. And you can go there by searching fidelity.com/in the money follow-up. And if you're looking for further insights, or maybe you just weren't able to attend today's session, Sign up for our Active Investor weekly newsletter. You can go there by searching fidelity.com/active investor weekly. I'm more looking forward to next week's episode, but until then, I wish everybody the best. Thanks for being with us. Take care.